Hello, welcome to BeyondBacktesting.com. This is Curtis, and today we're going to talk about how to trade options like futures. But first, please read over this risk disclaimer, this risk disclosure. Futures and options trading is risky. This is not suitable for every investor. Only trade with risk capital you can afford to lose. And this is, I never make recommendations to buy or sell. It's only for educational purposes only. So please read over that, understand it. And today we're going to talk about Tradestation. This is Tradestation, and this on the right here is the Tradestation Matrix. And I love the Tradestation Matrix. And what you may not know is that you can trade options on the Tradestation Matrix. Now, many of you will know that, but many of you will not. And so I want to show you how to set that up, okay? If you come from a futures background, you're probably used to trading off the DOM, or the depth of market, right? And that's one of the appeals to it. It's a very simple way to trade. Options can be more complicated because you can structure more advanced trades, but if you want to trade them directionally, if you want to treat them like an outright or a future, you can actually trade options just like your common stock or your futures, and you can trade them in Tradestation off your matrix. You could also trade them off the chart trader too. And I'm going to show you how to set all this up. Okay, so what we have here is we have Microsoft today. To give you a little context, we opened up here at about 168, 169, and we traded up all day, and we closed at 174. And this is your option, the call option, that would have been slightly out of the money this morning, and you can see how it traded. Now, to set this up, you're going to go to your apps, okay? You're going to go to Option Station Pro, okay? And I'm going to pull that up. I've already got it here. And you're going to punch in your symbol here. And what's key is on the left side is your calls. If you're bullish, you buy calls. And on the right side is your puts. If you're bearish, you buy puts. You typically do not want to sell an option to open it in this style of trading if you want to be risk limited. Because selling an option can have a much higher risk than if you sell a call, it's some quote unquote unlimited risk. If you sell a put, your risk is basically whatever the maximum, the stock could go to zero, right? So the one thing with this style of trading is you're always buying to open. That's the key to it. Okay, you're going to buy to open and then sell to close or close the trade. You never short unless you understand what you're doing. So the key is you're going to find, the first thing you're going to look at is you're probably going to go to the nearest expiry, okay? And this one's in 2 days. You're going to look at the open interest or the volume and see where, basically you want to go where the most volume is because that's going to be your liquidity. Okay, then this morning we were trading at 168, 169, so you want to be slightly out of the money. So that's probably going to be where you're going to get your best bang for the buck. You could, in terms of risk, right? If you go more into money, you could also do that, or at the money, you could do that as well. If you think you're going to get a much bigger move, you could get more out of the money. But typically, you're going to be probably slightly out of the money, which would be 170 or 172. Now, once you choose your kind of your road, right? Imagine this is this morning, and the market's at say 168, 169. You're bullish. You think Microsoft's going to go up, so you're probably looking at 170, 172. And you're going to right click on this, copy symbol, okay? Then you can go to you can do Control-Alt-C to open a new chart and choose your time frame. If for whatever reason you had a chart that was open, you can do spacebar, Control-V to put that in there, okay? Now you're mapping your option. So basically this is saying that, we opened up at one, if you bought it in this area between $1 in this first 5-minute bar, you would have paid between approximately $1.50 and $2 for it. That's been because it's a stock. Now there are options on futures and index options. Those are different. You have to review how those work, but it's basically worth 100 shares. So you're risking between $150 and $200, and if you had held this to the end of the day, it would have been worth approximately $485. We'll call it $500. So you made $300 with a $200 risk, right? So your R is pretty good in that case. It's like, and that's a maximum risk if you'd held it to zero, obviously, or if you'd held it till expiry. So that's kind of how it works. Now, how do you get into the matrix, right? Over here, click on the symbol, in this toolbar thing, hit space, Control V. Now you have it in the matrix. Okay. And the key is this C here. This tells us the call option, right? And if you're bullish, you want to be on the call option. So if you're ever, that's going to be the key. And one thing you could possibly mess up is you want to make sure that if you see the C there, it tells you it's a call. If you see a P, that means it's a put. Okay. And so the other thing you can do is you can also, and you see I've already done this. I'm going to remove this so you can see how this works. And remember, you'd be setting this up in the morning before your trading day. Once everything's in the matrix, you can trade very efficiently. It's just you can do buy market or put your limit orders in, and you're going to be very speedy, fast. Pre-market, you would have to select, kind of narrow down what you're going to trade and get everything set up. So you can Control V and put that symbol in your symbol list. Now, what you can do is you can link it, okay, to the chart and to here, which I've already done, okay, green link. And now what that allows you to do, and I'll put in another one so we can see it. So that's the one we have put 170 in. We can also put the 172 in. Oops. Okay, and what that allows you to do is basically that's to switch between them. So we can see there, the 172 was a little more out of the money, so it was cheaper. You use less capital, and that's pretty much all there is to it. Now, if you're going to be trading long and short during the day, let me show you the put. For the put option, if you were bearish this morning, we were open up 168, 169. You would probably went to 167.5 or 165. You copy this symbol, and put it here, and you'll see it has a P in it. Okay, so that P there, it tells us to put. If you were bearish, right, you would have been looking to buy the put option. You're always buying to have the risk limited trade. Now, if you're trading long and short, you're probably going to want to copy this matrix and have two side by side. You put your calls on the left, and you're basically one matrix for your call option, one matrix for your put option. I'm not going to show that, but it's pretty much you just duplicate the matrix, and that's how you would do that to trade long and short the same symbol. What else? Let me talk about some of the benefits of why you might want to trade options, and also some of the detriments. Why would you want to day trade the option versus the future? Well, first thing is the capital efficiency. Okay, in this case, you're putting $200 of your capital outlay, versus with the stock you're putting $16,800 outlay. Now with so that's one of the capital efficiency is just a lot better. Is that the biggest thing? I don't think so. Maybe for some, but I don't necessarily know that it's the biggest thing. But it's certainly something that could be important, right? I think the more important thing is actually, well, two things. First, we'll talk about the single stock risk. Okay, Microsoft is very liquid and very, probably very safe, but not every stock is like that. For example, this past week, and I'm not an equity trader really to any degree, but I became aware that a stock called Luckin or Lucan Coffee, I guess Luckin Coffee, which is I don't know very much about it, so I may be wrong on this, but I think it's like a Starbucks, a China Starbucks. I know I was going to buy it at one time for an investment, and I just didn't. And but anyway, it was halted. It got halted this past week, and when that happens, sometimes those halted stocks don't open back up. Or they could open back up and they could be gapped, much lower or higher. And what that means is, obviously for an investor, it's very bad. Could be very bad, and make for a large loss. But for a trader, it could be catastrophic. And understand why. Let's say you were actively into day trading, and let's say you bought, somewhere in here, and you put your stop. Your discipline. You put it, where you're risking maybe, whatever amount you decide that's reasonable, $100, $200, $300, $400, whatever it is. and you put your stop in. Well, now the stock is halted, okay? And you think about an intraday trader, you're trying to catch a small move. So to have that be for that to be meaningful, your leverage is going to be a lot more, and not necessarily because you're trying to leverage up to the hilt, but more of because of the amount that it's moving, right? And so you could end up losing thousands of times more than what you intended to lose, and that could be catastrophic if you were halted, if there's a news event or something in stocks. And with futures, that you obviously have this, that risk is mitigated somewhat because you're trading the entire market. You obviously, something can happen that that causes big swings, but it's somewhat mitigated with futures because of liquidity, because you're trading the entire market. Compared to single stocks, right? So that's one of the benefits of trading the option, is that you don't have that risk. Obviously, different stocks will have different risk of gapping or being halted and having that type of movement. And I know my understanding is biotechs or can be very likely, and obviously stocks that are making huge swings are going to be more likely to be to have that type of a risk. But that's a real concern, right? The other big advantage, and I think this is more universal. Obviously, that's significant from a soundness. Having that risk of potentially your stock getting halted and your money stuck or losing many times what you intended to lose, right? That's a very real risk. But also the other more, let's just say this, the other more common advantage with you get from trading the option is, let's say you bought this morning with the outrights, and you had your $16,800, right? And you're going to say, okay, it's Microsoft, so you're not truly risking all that. You're risking some percentage of that because it's not going to go to zero in a time frame you're holding, at least. But where is your stop at? Okay, if you buy, say here you're down 100, then you're down at 200, then you're down 300. So you're going to have to pick a stop. And so if you're very sophisticated, day trader, you maybe picked a very tight stop this morning. Well, you probably got stopped out. If not, if you were looking for a big move today, you might have had to, you're going to have to pick a stop level. And let's just say you picked $1 for your stop. Well, you're stopped out. So the fact that it can keep going against you means you have to pick a stop. Where should, if depending on the thesis for your trade, that stop, does it really matter if it, say, Microsoft went here? Does that really mean if you have a sound thesis that it's going to, rally today? Is that likely to invalidate your thesis? Probably not, right? If it goes, and so, but you're going to have to pick a stop level to control your risk. Well, because obviously it goes against you, you're losing more and more. So, and you're risking 100, 200, 300, 400, right? With the option, you have some more flexibility in terms of how you trade with the stops. If you had bought it this morning, you could have said, I'm risking a maximum of 200, and if I see the trade's completely busted, I'll close it, or I'll give it some extra room. And it's different with the option for a couple of reasons. Let's imagine that you were with the stock and you've got your $16,800, all right, at risk. So it's basically the same as this. So you're basically every dollar it's $100, right? So somewhere down here you're down probably around $500-$600. Okay, and let's say it doesn't work. The trade doesn't work. Then at the end of the day, you're going to close it for a loss, regardless of if you use a hard stop or whatever, or if you gave it room, or you'd have to hold it over the close, and that's taking a lot more risk. So that gets into a different type of trading, a different style of trading, or even it may not even be trading, depending on maybe more like basically just gambling, or it could be trading, but it's not going to be give you the type of leverage for intraday trading, right? If you cut your risk down to the level where you could hold it overnight. So, but with the option, you could set your stop at entry, right? Or you could you could have say, okay, I'm gonna give it basically 50%. Maybe I'll cut it at 50%. Or you could say, I'm just gonna let it. I'll just close it at the end of the day, or whatever. But here's the difference. This expires in 2 days. Okay, which means that your risk is still limited. If it had not worked on that first day, you could have held this. And I'm not saying this is good or bad. I'm just saying you could hold this, and your risk is still completely limited. So on this case, if it went against you, not only would you have been risking a lot more in dollar terms, right? Also, at the end of the day, if you wanted to hold it for a possible recovery, you're taking a lot more risk because now you're holding it overnight. So really, gives you a lot more flexibility. So that's pretty powerful there, right? I think that's one of the big benefits is you can be more flexible with your stop losses. The other thing is, let's go to here intraday. If you had seen something to catch this move, let's just say you did. I actually did. I didn't. Well, it doesn't. What I did or didn't do doesn't really matter. But let's just say that you seen something set up here, okay, and you wanted to catch this swing. I'm going to go with the 172. I'm going to go with this one, okay, the 172 calls, okay. So we'll assume you caught it somewhere in here for $2.50. So basically, you paid $2.50. So you had $250 at risk. And you made, and it was, and then you close it out. We'll say for 325, and you caught pretty much the whole thing. So you risk 250 to make 325. If you do the math, you're basically making 75 for 250 risk. If you didn't set a stop loss, but with the matrix, you could set a stop at entry. So you could have set a little bit more, but you could have set basically a 20-cent stop. 250 minus 20 been 230 down at this low here. 20-cent stop would be $20 to make basically $75, right? Which is just 325 minus the 250. So that's what a 3R trade. Okay. So that is how you can trade with the options. Let me show you one other thing. Going up to a 30-second chart, we can see the actual trades that took place. We can see that it's not near. If you get on the 30-second here, it should be a lot. It's going to be a lot more smooth. You can see so we can see the liquidity is not as good now. Just because we didn't have a trade that took place doesn't necessarily mean that the spread was that big, because the spread is moving, and you'll see it during the day. The market will be made during the day, throughout the day, right? And so there could have been more trades placed, but there may not have just been the interest to place them. So when there's trades missing, it could be because the market was the spread was wide or gapping, or it could also simply be that there wasn't any interest in trading those locations. So it's a combination of that. As to how liquid it is, but you want to be aware of that. Now the market's closed now, so we can see here it's basically a $32 spread because it's closed. It wasn't that; it was much tighter during the day. Now let's talk about some of the downsides of trading. Trading the option versus the outrights. What are some of the downside? I'm just trying to adjust that. So downsides. If you're day trading with Tradestation now, you can trade equities commission free. So if you're doing a lot of trades, you want to be equities, and it's pretty much you're in equities if you're trading very actively, because the commissions are very big, right? A very big factor. With options, I think it's 60 cents to open, 60 cents to close per contract, so that's $1.20. Just not a lot if you're only placing a couple of trades a day, but if you're very active, it could be a very big thing. Plus, the spread in options is going to be bigger too. So the more if you start to trade more trades, that spread is going to become a bigger factor. What else? Obviously, if you want to trade with a very tight stop, you potentially could do that better with the stock because it's more liquid. So that's another consideration, right? There are some benefits depending on how you want to trade that may say, okay, I would be better off trading the stock versus the option. Where the option I think is going to be best is for certain types of plays, or if you're taking a few trades a day or looking for reversals, or that may be where the option, for trading the option does better. Or if you don't have a specific stop in mind, okay, you can't find a very good stop, or you don't think the trade is structured statistically where the stop would be meaningful, but you still want to limit your risk, then the option is going to be better. Some other considerations are the spreads on the options can change based on the market environment, right, and the volatility. Of course, the spreads on the stocks can change too, but in very volatile conditions, the options may not be tradable. It will be tradable, be more difficult than trading the outrights. But I think I can see myself using and trading options in this way, and I like it, especially from the with the matrix. For very active scalping, I'm still going to be trading. That's a different game where you're probably better off in equities. But if you're looking for a couple of reversal trades, or then this may be something to consider. Hope you enjoyed it. If you liked it, please like and subscribe, and we will see you next time.